Money has rules, not written, not taught, but unbroken for over 3 centuries. They exist beneath every crisis, behind every fortune, inside every paycheck that loses power each year. Most people never see them, yet they decide everything: who climbs, who stalls, who falls. The rich don't stay rich by chance. The poor don't struggle by fate. It's not luck. It's not conspiracy. It's law. 3 invisible laws that have shaped every empire, every boom, every collapse. They govern the flow of value the same way gravity governs motion. And once you understand them, money stops being mystery. It becomes map. By the end of this video, you'll see how those same 300-year-old rules still control modern wealth. Comment your country and time zone. Let's see how far these laws travel across the flow. Money doesn't move at random. It follows laws. Silent, mathematical, older than any central bank. The first is Gresham's law. Bad money drives out good. 300 years ago, coins were made of gold and silver. Rulers began mixing cheaper metals to stretch their supply. The coins looked the same, but people could feel the difference. The smart ones hoarded the pure coins and spent the fake ones. Over time, real money vanished. Only the bad remained. That same law still rules today. The metal is gone, replaced by credit, debt, and trust. When central banks flood the system with cheap money, when interest rates stay low and debt becomes easy, the quality of money decays. The supply expands faster than the value it represents. In a world awash with liquidity, good money hides. People stop saving and start speculating. They chase the fastest return, not the safest foundation. Savings shrink, discipline fades, and who gains first? Those standing closest to the money printer, the banks, the corporations, the funds. They catch the first wave of new dollars before inflation waters it down. By the time it reaches the public, each dollar buys less. Gresham's law isn't history. It's your paycheck, losing quiet value month after month. It's the invisible exchange that happens between the patient and the leveraged, between the saver and the speculator. When bad money floods the market, good behavior disappears with it. The second law is the Cantillon Effect. It defines how that flood spreads, unevenly, predictably. Money flows unevenly. Imagine rain falling on a dry field. The puddles closest to the source fill first. The outer edges wait for leftovers. In the economy, those puddles are the financial institutions, investors, and asset owners. When new money enters through stimulus, bond purchases, or credit programs, it reaches them first. Prices of stocks and property rise. Bonuses grow. Meanwhile, the outer edges, the workers, the savers, the small businesses, feel the water only when it's already mixed with mud. For them, prices climb before wages do. Every printed dollar has a direction, and it always flows uphill. After 2008, trillions in liquidity lifted markets threefold. The top 1%'s wealth soared. The median family's income barely moved. In 2020, the same cycle repeated. Markets recovered long before households did. Each crisis rewards the early receivers. Each recovery pushes assets higher, wages later. This isn't luck. It's geometry. It's the structure of the flow. Cantillon's law is the mechanism inside every bailout and every boom. It explains why the same names rise after every collapse. It's not favoritism, it's sequence. The money enters there first. The third law is the Pareto Principle, the law of concentration. Wealth concentrates. In any system, 80% of results come from 20% of participants. Pareto noticed it in 19th century Italy. 20% of citizens owned 80% of the land. Over time, the pattern hardened, compressing into 10%, then 5%, then 1%. The ratio doesn't depend on politics, it depends on behavior. Those who understand money compound it. Those who don't lose it through inflation, taxes, and timing. Markets don't reward effort, they reward insight. Every era repeats the curve. The few who read the flow capture its momentum. The many drift inside it. Today, the top 1% control over 30% of global wealth. In the markets, A handful of companies drive most index returns. A few funds steer most of the capital. It's not a conspiracy. It's compounding. Once proximity forms, it reinforces itself. Capital attracts capital, the way gravity pulls matter. The closer you are to the mass, the stronger the pull becomes. Put together, these three laws form the invisible architecture of modern finance. Gresham explains why quality decays. Cantillon explains who gains first. Pareto explains why imbalance endures. Together, they create a current that never stops flowing, from saver to spender, from late receiver to early, from the periphery toward the center. This structure is neither moral nor malicious. It's mechanical. It functions the way gravity does, impartial, constant, predictable. Every time governments attempt to fix the economy with cheap credit, the same sequence repeats. Bad money drives out good. Early receivers grow richer. Late receivers carry the cost. Look around, in every boom, every bubble, every bailout, and you'll see the same choreography. Debt expands, assets inflate, concentration deepens. The names and currencies change. The math does not. These laws do not rest. They only shift form. And once you start recognizing their rhythm, you stop mistaking symptoms for surprises. Inflation isn't random. Inequality isn't new. Market cycles aren't chaos. They're echoes, waves created by rules written before your nation existed. 3 laws, 3 centuries, 1 pattern. Money flows like gravity, downward for some, upward for others, always toward the same source. And if you can learn where that source begins, you can stop fighting the current and start positioning yourself within it. In 2008, a young couple watched the world change through the glass of a small apartment window. They worked, saved, waited. Every month, they cut corners, skipped dinners out, filled spreadsheets with hope. Their dream was simple: a home, stability, a place where effort finally turned into security. Then came the stimulus. Interest rates fell. Cheap money flooded the system. Banks borrowed easily. Corporations bought assets. Investors snapped up homes as safe stores of value. Prices rose faster than paychecks could follow. Each headline promised recovery. Each year the couple saved more. But each round of intervention pushed homes further out of reach. Their savings account grew in numbers, but shrank in meaning. They didn't lose because they were lazy. They lost because they stood too far from the source. The new money reached them last, after it had already inflated the prices they chased. Gresham's law turned patience into penalty. Cantillon's flow rewarded those upstream. Pareto's gravity pulled ownership upward and left them orbiting below. They still saved. They still worked. But the system rewrote the scoreboard while they were playing. That's what makes these laws dangerous. They don't punish effort. They punish distance. And unless you understand how money moves, it doesn't matter how hard you swim. The current decides who reaches the shore first. In 1971, the world quietly crossed a financial event horizon. For centuries, money had weight. It was metal, scarce, self-limiting. Every coin in circulation was a fragment of the earth itself. But that summer, the connection between currency and reality snapped. The United States closed the gold window. Paper no longer promised redemption in gold. It promised itself. Overnight, money became pure credit, an idea backed not by scarcity, but by confidence. It was a pivot so profound that most people never noticed it. Gresham's warning echoed across time. When quality disappears, quantity replaces it. Freed from restraint, credit expanded like air rushing into a vacuum. Debt became policy. Central banks discovered they could steer economies by creating liquidity, not mining it. Governments could borrow without waiting for tax revenue. Growth no longer required productivity, only permission. For savers, the ground shifted. The virtue of patience, once the foundation of stability, began to erode. Why hold cash that yields nothing when asset prices climb every time the printing press turns on? And so began the age of speculation. Houses became investments, not homes. Markets became casinos for policy expectations. Each cycle of easing inflated the next one higher. The line between wealth and leverage blurred until they became the same thing. By the 1980s, the global system had adapted. Debt was no longer danger. It was design. Borrowing created spending, spending created growth, and growth justified more borrowing. The machine fed itself. Gresham's law now operated in reverse. Quality money, disciplined saving, delayed gratification, disappeared from circulation. In its place flowed quantity, credit, leverage, promises. The system didn't collapse. It evolved. It found a new equilibrium where the constant expansion of debt became as natural as gravity pulling downward. And as every decade passed, the same pattern repeated. Cheap credit lifted markets, inflated assets, and eroded purchasing power. Savers fell behind, asset owners pulled ahead. The more the system expanded, the more inequality hardened. This is why 1971 still matters. It wasn't just the end of the gold standard. It was the beginning of a new law of motion, one where value was untethered from matter and anchored instead to belief. From that point forward, every crisis, every bailout, every boom followed the same rhythm. Money expands, quality declines, trust fills the gap, until the next shock resets the faith again. Debt became the new gold, the collateral, the currency, and the cage. If you understand 1971, you understand every crisis that followed, because they're all echoes of the same moment when gravity changed direction and the world decided to float on promises instead of weight. Numbers tell the story more clearly than any ideology. Slide 1. Top 1% wealth share, 1989 to 2023. The line doesn't rise, it climbs like a wall. From 23% to over 32%. Every crisis makes the slope steeper. Every recovery locks the gains. Slide 2. Real wages versus asset prices. Two lines start together then diverge like broken rails. Wages crawl, assets sprint. The space between them is where inequality lives. That gap isn't emotional. It's arithmetic. Each stimulus round widens it further. When central banks print, the first receivers buy assets before prices adjust. When households finally spend their checks, the cost of living has already moved. It's not a conspiracy. It's geometry. The Cantillon flow in real time. Look at 2008. Trillions entered the system. Markets tripled. Median income barely changed. Look again at 2020. The same script, only faster. Digital stimulus, instant transfers, instant inflation. Those with capital gained compounding velocity. Those with wages gained higher bills. This pattern is not new. It's structural. Money flows through channels built centuries ago, rivers that always run uphill. The closer you are to the source, the sooner you feel the warmth of liquidity. The further away, the colder it arrives. What you're seeing on those charts is not luck or policy failure. It's law in motion. Bad money drives out good. Uneven flow rewards the early. Concentration follows gravity. So when people say, the rich got richer, they're not describing greed. They're describing physics. This isn't emotion. It's math. The mathematics of flow, repeating through every stimulus, every decade. Every promise to fix what the system was designed to repeat. Today, the entire system turns like a self-feeding loop. Governments borrow to fund promises. Central banks buy that debt to stabilize markets. Banks lend against those assets to fuel consumption. The cycle repeats. Credit creates money, money inflates assets, assets justify more credit. On paper, it looks efficient. In reality, it's decay wearing growth's disguise. Each expansion stretches the gap between price and value, between productivity and perception. The numbers rise, but the foundation thins. When governments run deficits, they call it stimulus. When central banks print, they call it liquidity. When markets surge, they call it confidence. But all three describe the same process, the conversion of future effort into present illusion. Every participant acts rationally. Governments borrow because voters demand more. Banks lend because rates stay low. Investors chase yield because cash rots in silence. Workers borrow to live because wages lag. Everyone plays their part perfectly, yet the system still decays. This is how the invisible laws enforce themselves. Gresham's principle turns quality into quantity. The more we print, the less each unit means. Cantillon's effect distributes that decay unevenly. The first receivers gain, the last receivers pay. And Pareto's gravity pulls the results upward. The compounding advantage hardens until it becomes structure. Inflation isn't an accident, it's maintenance. It keeps the machine running by slowly erasing yesterday's promises. Debt isn't failure, it's fuel. The more we owe, the more liquidity must flow. The system survives not by balance, but by motion. You can watch it in real time. Governments issuing bonds, central banks buying them, assets rising, rents climbing, purchasing power eroding, a seamless loop powered by trust and momentum. The early receivers ride the wave, the rest drift in its wake. And as long as money flows this way, the loop never truly breaks. It only tightens. Understanding the laws is one thing, using them is another. You can't stop the current, but you can learn to move within it, closer to the source, where flow becomes opportunity instead of erosion. Here's a framework, 5 steps to reposition yourself inside the system that never stops moving. Step 1. Core versus satellite assets. Hold what resists devaluation at the core. Assets that store energy, not promises. Land, productive equity, commodities, scarce digital stores of value. Around them, build satellite positions. Flexible, adaptive, smaller bets that can move with cycles. The goal isn't speed, it's endurance. In a system where money decays, scarcity is defense. Step 2. Move closer to credit. Proximity matters. Those who touch credit early benefit first. That doesn't mean owning a bank. It means building skills, businesses, or intellectual property that attract capital instead of begging for it. When you create value that credit seeks, you shift from borrower to magnet. Ownership, not employment, is the gravity that pulls you nearer to the flow. Step 3. Use debt productively. Debt isn't evil, it's leverage. A current that amplifies direction. Unproductive debt sinks you. Productive debt lifts you. Borrow for assets that generate returns greater than their cost. Never for consumption that ends when the receipt fades. In a world where credit is infinite, discipline becomes rare, and rarity compounds. Step 4. Track macro signals. Every expansion and contraction begins the same way. 3 signals matter most: interest rates, quantitative easing, and credit spreads. Rising rates tighten flow. QE loosens it. Spreads reveal where stress hides. Don't predict, observe. The earlier you sense the turn, the closer you are to the source. Step 5. Rebalance regularly. The system shifts in cycles: expansion, contraction, disbelief, relief. Rebalancing keeps you aligned with motion, not memory. Move capital gradually from overheated assets to undervalued ones. Review quarterly, act deliberately. The flow rewards adaptation, not attachment. This playbook won't rewrite the laws. It simply helps you work with them, not against them. Money behaves like gravity. Resist it, and you fall. Align with it, and you orbit. Comment playbook. If you want this checklist, not as theory, but as a map to reposition yourself closer to where the money begins, where compounding isn't privilege, but proximity. Even gravity flickers. There are moments when the current seems to reverse, when the flow punishes those closest to the source and rewards those furthest away. 1981 was one of them. The Volcker shock slammed interest rates above 20%, breaking the spine of inflation. Credit contracted, speculation froze, and for a brief moment, the laws inverted. Cash regained power. Patience paid. 4 decades later, in 2022, it happened again. Central banks tightened with historic speed. Leverage cracked. The same markets that had climbed on cheap liquidity sank under its withdrawal. For a short while, savers held advantage while borrowers bled. But these inversions never last long. They are corrections, not revolutions. Systems built on credit can pause, but they cannot reverse without collapse. The flow always resumes toward expansion, toward concentration. There are moments when the laws invert, but only for those already in orbit. The exceptions prove the rule. Each flip reminds us that stability isn't the opposite of volatility. It's the shadow it leaves behind. The next era won't erase the laws. It will digitize them. Central banks are building CBDCs, programmable currencies designed for precision, speed, and control. On the surface, they promise modernization, instant transactions, seamless stimulus. In practice, they deepen proximity. The early receivers remain the same: governments, banks, corporations. The flow simply moves through new pipes. Money becomes code. Access becomes permission. Every transaction traceable. Every issuance adjustable. With one command, liquidity can surge or vanish. The structure doesn't break. It upgrades. The flow still favors the center. Meanwhile, the world edges toward de-dollarization. Nations diversify reserves, shifting from one issuer's dominance to a basket of influence. But this isn't revolution either. It's rotation. The cycle repeats at a global scale. The issuer still benefits first, the holders later. Digital tokens, private coins, and decentralized networks try to rewrite the script. Yet even they bend toward the same laws. Early adopters accumulate before the crowd. When trust expands, quality retreats. Bad tokens flood the market, good ones hide in cold storage. The platforms change, paper to screen, vaults to wallets, but gravity doesn't. Value still flows towards scarcity, control, and trust. You can change platforms, but you can't change gravity. The future won't replace the laws of money. It will amplify them, faster, deeper, and with less room to hide. 3 laws, 3 centuries. One question: where do you stand in the flow? Are you drifting at the edges, watching the current shape your life from a distance? Or have you learned to move closer, to see how value really travels beneath the surface? The flow hasn't changed, only the players have. Understanding it is no longer optional, it's survival. Every paycheck, every investment, every debt payment is a choice: to align with gravity or resist it. Comment your country below. I'm mapping how these ancient money laws still shape modern economies. And subscribe for the next episode: Proximity Compounds, 4 legal ways to move closer to the source. The current of money never stops. Those who study it learn to ride it. Those who ignore it get pulled under. So ask yourself, in this endless flow, where do you stand?